What's up guys, welcome back to the daily stock picks, and in this video we'll be going over the top 4 robotic stocks that you should consider buying right now in September 2020 according to this article by Investors Place. So what I've done for you guys is I've filtered through these 8 companies and put forward 4 companies that look pretty promising for us to do our detailed analysis. So I'll be reading over this article with my beautiful voice pertaining to those 4 companies, commenting, and will be conducting my own quantitative analysis to see whether these 4 companies either belong in our dividend portfolio or our value portfolio by using this checklist. So if you guys feel like being amazing, I would really appreciate it if you guys can give an early thumbs up. I'll wait for it. And thank you. And now, without further ado, let's get this video started. So 8 innovative robotic stocks to buy right now. No pandemic can stop these groundbreaking companies from transforming work and life, by Josh Inomoto, Investor Place contributor. Despite the carnage caused by the novel CVPD, the one investment sector that has outperformed so many others in technology is technology, and within this broad segment, robotic stocks represent a viable long-term pathway of success. Previously relegated to gimmicky inventions, the advent of revolutionary developments in machine learning and automated manufacturing infrastructure has given this market substantial insulation in this crisis. Back in 2017, Boston Consulting Group noted that the robotics industry was growing faster than expected. Due to the increased demand for commercial and consumer automated applications, BCG upwardly revised its 2025 market revenue forecast to $87 billion, and that could be on the conservative end. Tractica projected that the industry driving robotic stocks will hit $237 billion by 2022. Of course, the novel CVPD has disrupted the immediate trajectory, but against the longer time frame, the pandemic could turn out to be a net positive for robotic stock. Primarily, robotics and automated solutions don't get sick. Therefore, while we humans are sheltering in place for the next health-related crisis, robots can do their job with minimal supervision. A second factor supporting robotic stock is the economic necessity of tech-enhanced workforce. As you know, this present crisis brought to the forefront glaring social inequities. One of the most popular solutions is to raise the minimum wage, but that requires companies to comply. Will they? Of course not. Instead, they will placate the masses with empty promises while coldly replacing their labor force with automated systems. Unfortunately, there are no easy answers to solve broader inequalities. The best course of action is to consider these 8 robotic stocks to buy. And out of these 8 stocks, these are the 4 companies that I've filtered, which have positive cash flows and seems to be profitable just by glaring at it, which we'll be doing the analysis one by one as we go along this video. So finally, the autonomous machinery has strong foreign policy implications. China has made it no secret that it wants to dominate the world economy through initiatives like Made in China 2025. Naturally, the US will have something to say about that. This competitiveness only improves the case for these robotic stocks to buy. So the first company that met my criteria is Alphabet, ticker symbol GOOG and GOOGL. Usually, most investors associate Alphabet with the internet, not with robotic stocks. In fact, Alphabet attempted many ventures in the past with automated machinery to no avail. Therefore, the news that the company was re-engaging its robotics division probably doesn't sway prospective buyers of Google stock. If you were going to buy shares, you probably would have done so irrespective of the company's automated machinery. However, this time, Alphabet's take has a robust mixture of innovation and practicality. Now the focus is on mechanical hands, grasping objects and navigating new environments. Theoretically, this development has significant implications for consumer retail, as menial tasks performed by human workers can be completely automated. Granted, the robotics component of Alphabet has never been much of a selling point for Google stock, but while you're waiting, the company offers myriad businesses that are relevant now. Okay, looking at Google stock, ticker symbol GOOG, we can see that the earnings price to earnings multiple is 35.98, which is expensive than the S&P 500 index, which is 29.46. And in order for a company to meet my dividend portfolio, it basically needs to meet 4 rules that are based upon these 3 books, which I highly recommend reading out. So the first rule is that the current free cash flows must be positive. So you want to be investing in companies that have positive cash flows, which I've already filtered out for you guys as we're not discussing about the other companies mentioned in this list. And the rule number 2 is that the dividends that are being paid out should not be more than 75% of the current free cash flows. What does this mean? This basically means that at least 25% of its dividends of its free cash flows can be reinvested back into the business, or the management has control over, rather than paying out its dividends, right? And rule number 3 is that it needs to have a consistent dividend history of at least 5 years. But if you want to be on the conservative side, you can consider a dividend growth history of at least 10 years or more. And rule number 4 is our buying criteria. We want to be buying the stock when the current dividend yield is greater than or equal to the 5-year dividend yield average. Now, coming to this, I like to use Y charts, as you guys already know, for getting these financial data. Looking at Google, we can see that the current free cash flows is positive, but since it does not pay out any dividends, we wouldn't be considering it as a part of our dividend portfolio. But rest assured, we can consider it whether it meets our value portfolio. So in order for a company to meet our value portfolio, it needs to meet 5 rules this time. And these 5 rules are based on these 3 books. My personal favorite is this one, The Little Book That Beats the Market by Joel Greenblatt, where he goes over his infamous magic formula. So the rule number 1 is that the return on invested capital must be greater than or equal to 10%. So higher the number, the more profitable the company is. And rule number 2 is that it needs to have a consistent net cash flows. We need to be able to project the previous trend of the cash flows to project what the cash flows might be 10 years from now, just by looking at the previous trends and its growth. And rule number 5 is that it needs to have a strong balance sheet. So we want to be making sure that the long-term debt from its balance sheet can be cleared off within 6 years or less than 6 years. And rule number 4 and rule number 5 are our buy criteria. We want to be buying this company only when it is at least at a 20% markdown from its fair price. And if rule number 4 isn't met, if the price to earnings ratio is lesser than at least 50% lesser than the highest price to earnings multiple over the past 5 years, and it is lesser than the S&P 500 index, we can consider buying the stock by using the 5th rule. Now looking at this, we can see that the return on invested capital for Google is 17.75%, which definitely meets our first rule. The revenues have been increasing consistently. It's almost like a straight line. The cash flows, it was around $7 billion. Let's see how many times it's doubled. 7 double is 14, 14 double is 28. So around 2 doubles, around 15 to 20% year over year increase over the past 10 years. So the free cash flows are pretty good, and we can expect that the free cash flows can project into the coming future to a certain extent. And looking at the balance sheet, it has around $2.96 billion, which it can easily clear off with its current assets of $149 billion, which is nothing but the assets that can be converted into cash within the coming 12 months. So definitely a strong balance sheet. Now let's look at its earnings per share. Looking at its earnings per share, it's $45.47. And the price to earnings ratio at which Google has been trading over the past 5 years is 21.48, 65.47, and the analysts are estimating that Google can grow somewhere around 6%, 6.09%. Now looking at this intrinsic value calculator, what we're basically doing is we're growing the earnings per share with the analyst estimates, and once we have that, we have X as the future earnings per share, right? Now we need to divide it by a proper price to earnings multiple. We can either consider the 5-year price to earnings ratio or 2 times the analyst estimates. To be on the conservative side, you should be looking at the most minimum one, which would be putting the company's intrinsic value at $942.85 with a fair price of $268.02 at which we should be buying the stock. And if you were to consider 20% markdown, you should be buying the company at $214.41. Looking at the earnings price to earnings ratio of Google, we can see that currently it's $1,591.04, and analysts are currently recommending that this is a buy at the moment. Let's say, just for the fun of it, we consider 40 as the multiplication ratio. Even if you were to consider that, and even if you were to consider that, it does seems to be on the expensive side. If you were to look at it, let's just consider the average one, 43.48. It would put the fair price at which we should buy in the stock at $765. We don't know if Google is ever going to reach that, because you never know if the current situation might elapse. Google might fall. Highly unlikely though, but at its current valuation, Google does seem to be on the expensive side at the moment. Now, the next company in this list is Amazon, ticker symbol AMZN. If you head and over to Amazon's robotics division website, you're treated to a visual of future where we work seamlessly within its automated infrastructure. Does the e-commerce giant take us for idiots? Apparently the answer is hardly yes. Perhaps no one within the organization realizes that those machines will eventually replace most of its labor force. Those lucky enough to still be employed could find themselves working for the machines, not the other way around. When it comes to less favorable side of robotic stocks, Amazon is among the worst offenders. But you know what? That has nothing to do with the investment narrative of Amazon stock. Despite its extreme momentum, this is one of those names that you can confidently buy in rising strength. I'm sure it drives more than a few people nuts that the ultra rich continue to get richer during this crisis, but the albatross that Amazon is simply unstoppable. Eventually, consumers retail will be divided into two segments, Amazon.com and big box retailers. At least with ownership of Amazon.com, you can benefit from this ghastly situation. Now let's have a look at Amazon stock, AMZN. We can see that the current price to earnings ratio is 126.64, which is definitely on the expensive side when compared to the S&P 500 index. And looking at Amazon stock, AMZN, we can see that since it doesn't pay out any dividends, it can be a part of our dividend portfolio for sure. Now let's have a look at its value perspective. If you were to look at it, the earnings per share is 15.20, which is definitely a positive. The revenues have been increasing consistently. Now the cash flow is 2.5. Let's see how many times it's doubled. 5 doubles is 10 doubles is 20. So around 3 doubles, around 25 to 30% year-over-year increase over the past 10 years in terms of its free cash flows. And we can project it to a certain extent that it's going to continue in the coming future. And strong balance sheet. It has a current of $33.13 billion in long-term debt, which it can easily clear off with its current cash flows within the coming next 12 months. So definitely a strong balance sheet. Now let's calculate the earnings per share right now, or the intrinsic value. So its currently earnings per share is $26.01 per share. And Amazon has been trading at 70.68, 1005.75. So it does seem to be a discount at this current valuation, less than 50% of its all-time highs. And the analysts are estimating Amazon could grow over the past 5 years at around 36. So looking at the projections, we can assume that Amazon, if it does not split its stock, could be valued at around $29,000 or at least $30,000. And the fair price at which we should be buying the stock is $8,497. If you were to consider a 60% markdown, you should start buying the stock at $6,797. Even if you take a 50% margin of safety at this particular growth rate, you can see that it is below its intrinsic value considering a 50% markdown from this. And analysts are rating this company as definitely a buy with the 1.7. So definitely I would consider looking into Amazon at this current valuation of around $3,294.62 by using the fourth rule of the value investing principle, and it is at more than a 50% discount, guys. Now the next company in this list is Teradyne, ticker symbol TER. As the underlying innovations of robotic stocks become even more advanced, it is only natural for worker bees to think in dystopian terms. No, I'm not suggesting that machines become self-aware and thereby becoming truly autonomous. Instead of an apocalyptic bloodbath, human operators worry about losing their jobs. Fortunately, Teradyne has much more politically and perhaps economically palatable solution. Rather than researching true autonomy, Teradyne focuses on collaborative robots. What this entails is that the machines take over the jobs that no one wants, work that requires extremely autonomous functions or are outrageous dangerous. Instead, operators can perform duties that are minute in detail, enhancing overall productivity. As well, it's not clear if investments towards human replaceable platforms are financially sound. With Teradyne's collaborative innovations, we have a win-win situation supporting the narrative for Teradyne stock. Finally, Teradyne automated architecture can improve overall health outcomes of its client companies. Again, this is another win-win, making Teradyne stock an intriguing idea. Now, looking at Teradyne TER, we can see that the price to earnings ratio is definitely cheaper when compared to the S&P 500 index. Now let's see if it meets our dividend portfolio. So it has been paying out some dividends, but the free cash flows haven't moved that much over the past 10 years. It has indeed been decreasing over the past 10 years, which is not a positive sign. But currently the free cash flows are positive. I'm okay with that for now. Now let's see how much this equates to. 61.30 by 444.11. That equates to around 13%, or around 10% of its free cash flows is being paid out as dividend. And I'm highly unlikely that it would have been increasing its dividends over at least the past 5 years. I would be really surprised if it does. 4 years, almost there. Not there yet though, but from a dividend perspective, I would still hold on to it, or like wait for it for at least 1 year before investing it in a dividend portfolio. Now, looking at Teradyne from a value perspective, we can see that the return on invested capital is 24.75, and the minimum that I could find out was somewhere back in 2013 when it was 8%, which is not bad, but not good either. The free cash flows, a little bit concerned about it because we can't project it to a certain extent. Balance sheet, $402 million, which it can easily clear off its current assets. So strong balance sheet, yes. Now let's calculate its intrinsic value, $3.52 per share. And it has been trading at $12.49, 47.58. That equates to around 30.04. It definitely seems to be at a discount with its current valuations at the moment. And looking at the analyst estimates, analysts are expecting that the company should be growing at 16.66%. And that puts our intrinsic value at $96, at which you should be buying the stock. So $96, and currently it's trading at $78.60. You should be looking at the stock from that perspective. So Teradyne, you can buy the stock at this current valuation of $78.60 by using the fourth principle of our value portfolio, and as well as the fifth principle, because it is lesser than the 50%. I've just created a trade ticker, which basically shows us when the current price to earnings multiple is less than 50% of its all-time highs, and it's definitely lesser than the S&P 500 index. So definitely a buy in terms of a value perspective for Teradyne stock. The next company in this list is FLIR Systems, ticker symbol FLIR. During my CVPD fueled downtime, I've had a chance to catch up on some reading. For real-life mystery lovers, I highly recommend David Plotty's Missing 411 series, which dives into the unusual circumstances by which people disappear in our national parks. Among the high-profile missing persons cases discussed in the series is Stacy Araras, a teenager who simply vanished in Yosemite National Park in 1981. Araras has never been found, which raises the eerie question: why do so many people disappear in popular, well-trekked national parks? Another question you might be wondering: what does this have to do with robotic stocks? First, it's to be fair to the automation industry. While some of the innovations may take our jobs, companies like FLIR Systems develop vital technologies such as thermal imaging cameras, which feature civilian and military applications. Thus, you can feel good about supporting FLIR stock. Second, FLIR develops advanced robotics platforms for military and law enforcement use. By sending robotics first into hot zones, our machine and women in our uniform can safely gather intelligence. In addition, FLIR's robotics can help diffuse volatile situations. The company's life-saving solutions are yet another reason to consider FLIR stock. Now let's have a look at FLIR to see whether it meets our dividend portfolio criteria. Looking at FLIR, 33.55, slightly expensive when compared to the S&P 500 index, but the cash flows are pretty positive. Has increased from $189 million to $325 million. Now it does pay out a dividend of $91.69 million out of $325.58. That equates to around 28% of its current free cash flows, meaning that the remaining 70%, approximately 70%, can be reinvested back into the business in order to grow its top line. So definitely free cash flows are positive. Let's see how long it's been increasing its dividends over the past 5 years. Looking at this, FLIR has been increasing its dividends over the past 9 years, which is a promising look at around 11.20%. And looking at the dividend yield, FLIR currently has a dividend yield of 1.93%, which is higher than the S&P 500 index. So you should consider buying FLIR right now with its current valuation of $35.60 as a part of our dividend portfolio. But just for fun, I know it meets our dividend portfolio criteria, but I want to be looking at the value proposition as well. So FLIR, 7.08%, not that attractive when what we're looking for, but the free cash flows and everything seems to be okay. The balance sheet has around $846 million, which it can easily clear off within the coming 12 months with its current free cash flows. Definitely something good to look at. Now let's calculate the intrinsic value, $1.05, and it has been trading around the price earnings multiple FLIR. It has been trading around 15.03, 73.85, which is at a discount with its current valuations. Something to look at. And the analysts are estimating that the company should be growing at somewhere around 6%. So if you were to look at this, the intrinsic value would be somewhere around $21.29, and the fair price is $6.05, considering a 15% return on our investment. And the margin of safety at which we should be considering buying the stock, at least, or entering into the stock, is $4.84. With its current valuation, it doesn't seem to be a good buy, and most of the analysts are recommending this as a 2.3, which is somewhere between a buy and a hold. And they're estimating that the price target is around $47, but either way, it can be a part of our dividend. It can be a part of our dividend portfolio, but not from a value perspective, but as a perspective as a dividend paying stock, which I would highly recommend looking at the stock due to that particular reason. And rule number 5, we can see that it is at a discount currently, but it's not cheaper than the S&P 500 index. That's why it can be a part of our dividend portfolio, or of our value portfolio, sorry. Now the closing remarks. On the date of publication, Josh Inamoto did not have either directly or indirectly any positions in the securities mentioned in this article. A former senior business analyst for Sony Electronics, Josh Inamoto has helped broker major contracts with Fortune Global 500 companies over the past several years. He has delivered unique, critical insights for the investment markets as well as various other markets, including legal, construction, management, and healthcare. And if you guys have stayed around till this part of the video, I really appreciate it, guys. And full disclosure, this video is for education and entertainment purposes only. There is no guarantee that you will earn any money using the techniques and ideas mentioned in this video. This is not for financial advice. Please consult your financial or tax professional prior to making an investment in these companies. And if you want to stay updated with the latest articles, make sure that you smash the subscribe button and turn on the bell notification icon to get notified as soon as we post them. As you all know, that we post videos from Monday to Friday. And catch you in the next video. Peace.